Hello, I'm Shaun Richards of Not a Yes Man's Economics. What I wanted to look at today is the way that negative interest rates are arriving in the United States. Now, this is a trend through the credit crunch era we've seen in various places. And there was a time for the US, it was denied, thinking 6, 7, 8 years ago, or even some people saying that the US Federal Reserve couldn't actually do it. What tends to happen in these sort of situations goes as follows. It's sort of a stage process whereby we're told that they can't happen. People that might do it say they don't really want them. Then we find that they do. So we've got 3 steps here. Then the fourth step is we get lots of research later saying that negative interest rates are absolutely nothing to do with the people who just imposed them. And this has been a sort of recurring theme. We've seen this operate Japan, parts of Europe, and so on. And we think of Japan specifically, the Bank of Japan specifically denied negative interest rates were coming only 8 days before he imposed them. So life sped up quite fast. Coming back to the US, why is this an issue? Why am I thinking about it? Well, for example, two policymakers at the US Central Bank, the Federal Reserve, mentioned the subject yesterday. And this is my stage 2 I was looking at earlier. The central banks talk about the thing before, and like those did yesterday, tend to suggest they're putting it to one side. In my opinion, that's public relations. What are they doing? They're sort of getting in hand the view that they didn't really want to do it, so that when they can, they've got a prepared excuse. If we look at financial markets, there have been a couple of clues. Now, the actual official US interest rate is between 0% and 0.25. But at the end of March, we saw some US official rates go negative. What do I mean by that? Treasury bill rates did. Very short-term stuff, 1 month, 3 months, 6 months. But nonetheless, some US borrowing saw this through that phase. So that was step 1. This happened once before, but it's quite rare. How did that happen? Well, one of the factors driving this was that the US Federal Reserve started buying Treasury bills when they had the repo crisis I've spoken about before. And they started buying $60 billion a month. So that pushed prices up, yields down. You had the panic over the COVID-19 pandemic, and that's what led to negative interest rates. More recently, though, there's been another outbreak of this. And this is an old stomping ground of mine. Those of you who don't know, back in the day, my business was around options on interest rates. Now, interest rate futures in the United States have moved to a situation where roughly from the spring of next year until the summer, so April to August, we've seen the price go over 100, which means that the implied interest rate is negative. Now, this is sort of 2 things in one go. The actual moves are quite marginal and small, you could argue. But it's also very significant because no one's buying at 100.01, or if you prefer, an interest rate of minus 0.1% without realizing what they're doing. So there'll be some signaling going on here, but also some fundamental points. And it's also true that option contracts are trading, implying these sorts of levels. So there's 2 examples here of negative interest rates existing in the United States in the last 2 or 3 months. It is in itself a signal, but we see from experience that these things start there and then tend to spread. Ironically, like the pandemic itself, starts somewhere, moves into other areas. And that's what I fear next. If we get another downward leg in the economy, what else can the US Federal Reserve do? So don't be surprised if we see negative interest rates. Thank you.